Internally, we refer to that as the Goldilocks business model. When interest rates and, CapEx are kind of just right. It's not something you want to, balance sort of the future of the planet on.
Most CEOs are deliberate and careful, often neutering commentary of any hint of controversy. Sheldon Kimber is not most CEOs. He's known to pen 1,000 words or two on the ebbs and flows of the energy transition. His reflections are not always complimentary, but they're rooted in enabling the industry to reach new heights. But don't be mistaken, because Kimber is deliberate too. He uses his voice not for attention, but because he passionately believes the clean energy industry needs an unashamed advocate. And few can match his street cred. He built Recurrent Energy into a dominant solar and energy storage developer before launching Intersect Power, a fundraising monster that recently turned on one of the largest projects in the country. So what's his latest campaign? I'm John Engel, Editor-in-Chief of Renewable Energy World and Power Grid International. This week on Factor This, Sheldon Kimber wants you to forget everything you know about clean energy development. He's convinced a fresh business model is necessary to sustain an industry battered by rising capital costs, which have shaken even the likes of sector king NextEra. Clean energy is in desperate need of a new bellwether and way of thinking to survive and thrive. Kimber and Intersect Power are ready to lead the charge. That's all next on Factor This from Renewable Energy World. Sheldon Kimber, welcome back to the Factor This podcast. It's great to see you.
Thanks for having me. It's great to be back.
Yeah, I really enjoy talking to you because I think you give one of the most unvarnished takes on where the industry sits, what the opportunities are. And I think that's reflected too in your first appearance being aligned with the Oxen Solar tariff petition and the reason we launched this podcast. You were one of the few on the developer IPP asset owner side that wanted to talk to me about that. So I'll start with a thank you there.
Well, I'm not sure that everybody would thank me for it, but yeah, I try to give the unvarnished version of things. I think when we talked about Oxen, it was pretty straightforward. I mean, I think we were supportive of the outcome that we got, but I think I was probably a little bit more pointed than most about the fact that it was a challenge to the industry, right? And that it started a 2-year clock, and we're getting to the end of that clock. So it's going to be interesting to see how many people took it seriously and got done what they needed to get done.
And my last point on that because this is not an Oxen related episode. Thank goodness. I've been doing those for about 1.5 years now. What I appreciated about your perspective was it was not just here's the shot clock, but it was also here's the mirror that we need to look at ourselves in and acknowledge how we got into this position. And there are many different stakeholder groups that bear some responsibility for that, not just the big bad boogeyman Oxen. So,
Yep.
I appreciated that nuance at the time, and I'm hoping to have more of those conversations with you today. So just to recap a little bit, a lot has changed since we spoke in May of 2022. That was right before the Inflation Reduction Act was announced, ahead of this escalating interest rate environment that has really cast a good deal of uncertainty over the industry in many different segments. And really looking forward to talking to you about why you believe these changing dynamics require a new kind of thinking, a new business model for the industry to thrive and continue to grow and have lasting impact. And on that note, there is some growing belief that, residential solar and storage market could be in some serious trouble based on how that's financially engineered. NextEra has had a challenging couple of quarters as it's been faced by these high interest rates and financial pressures. And offshore wind contracts, in the Northeast have been ripped up left and right and are having to start over. Given all of that tension that we see in the market, I know there's still a ton of opportunity, but how would you characterize this moment that we're in as a sector?
I would characterize it as the inevitable coming apart of the coalition that came together to do the IRA, right? You can see it with the battles of ENGOs versus developers on hydrogen. You can see it with all of these disparate interests, right? So there's no doubt that everybody's impacted by interest rates, but when you talk about resi solar, you've got NEM 3.0. You've got, those headwinds. You've got offshore wind, which has very specific issues. Building an offshore wind facility, I think people sort of just think wind is wind, but, it's probably closer to building a nuke plant than it is to building a wind facility. So, you've got the Jones Act and, crewing with unions. And the issues are myriad and very complex and incredibly politically fraught. So I think that, the interest rate environment and the capital markets, and the policy tailwinds, the IRA, are all things we have in common. But the various things going on in the sector are more and more unrelated, and will only grow more and more, kind of disparate and unrelated as we go forward, as different companies find different business models and move forward on different paths. So I'm really hoping that we can get to a point where the press and the media in particular don't paint, everything that is sort of, like low carbon with one brush, right? We are a pretty diverse industry. There's also a couple of other, elements that come to play here, including sort of the fact that the Biden administration, I think at this point, is looking to us to be, a little more unified in supporting them in the election. So, while we have this kind of like chaos that seems to have emerged from higher interest rates and some of the other policy headwinds and things in various subsectors of the industry, we're also at that very same point that people want to show that displeasure and try to see if they can solve their specific problems. We are being asked as an industry to come together and sort of unite behind, the president and the legislative candidates that have given us the IRA in a pretty tough election year. And I think that's something that the industry is having a little bit of trouble doing. And I think we have to really see that the Biden administration and really policymakers in general we can't let them believe that we're a bunch of whiners who are going to kind of keep asking for more, right? And I think we're really close to that right now. I think they really look and say, we just gave you everything, and all you're asking for is the sort of, nits and gnats to go along with it. So I think there's a real danger there, and we need to think about how we get more politically involved this cycle, how we can show more support. There's a lot of money in our industry, but yet we still plead poverty when it comes to politics. Our friends in the fossil fuel industry don't. And so, these are things that I think, despite the headwinds, we really need to face down as an industry.
So why does that stick out to you, that whining comment? I don't think you mean it in a derogatory way, but more so that we've got the playbook and now we need to do something about it. And that tone of we need more is appearing more pronounced to at least me, that we need relief on interest rates. We need relief on trade. You got to get rid of Oxen. We need the moratorium to continue. We've got these supply challenges. But the IRA was a step change in where we were at as an industry. And now it seems like, these last couple of years, we're spinning our tires a bit, trying to figure out how we're going to realize all of these benefits. Like what needs to happen here, in your opinion? And not to mention that, Basel III, which we did or Basel, whatever it's supposed to be called. We did a podcast on that a couple of months ago about, these tax equity rules being considered by federal banks and so on. There are some serious challenges that face this space, but there's still plenty of opportunity.
Yeah, exactly. I think that is, I think that the administration, I'm actually quite confident that the administration and policymakers will get right what needs to be gotten right. And that includes, sort of the Basel III issues. That includes, redefining some of the early stage guidance around domestic content, which wasn't so much bad. It was just impenetrable, and which makes it unfinanceable, right? And so I don't know that they're going to fix necessarily, some of the offshore wind or hydrogen or some of these other things immediately. My hope is that they continue to work with those players and try to find solutions. But I think, we all have to get on board, the train at this point. I think, frankly, that leadership in the industry is what I'm going to sort of call out here, right? I think it's time that leaders in the industry really put their heads down now and say, we got what we've got. I'm going to create a business plan based on what we have in hand, which is still an insane amount more than what we ever had before. Certainty on tax credits, transferability. We would have done backflips down the hallway for this stuff, like, in 2019, right? And so I think it's time that we sort of put our heads down and write business plans that are based on what is, not what we wish would be. And I think that requires more leadership in respect of innovative business models, more leadership in respect of, innovative and interesting and creative development ideas, financing ideas, all of those things that create value out of the known policy rather than really, I spend a lot of my own time as a leader in this industry in the political realm, and I'm trying to discipline myself to get out of that mode. We will all have to at some level, but it shouldn't be seen. I think we've gotten into the rut of that's our job as leaders, to define a strategy that is about changing policy, and I'm not sure that is a workable way forward.
So, Sheldon, you're in these boardrooms and you're having conversations with not only your own organization, but, the trade association, American Clean Power. You're with those executives that you want to put their heads down and take advantage of this and really just get into go mode. What are you hearing in those conversations that maybe stands out to you where you say, I want to shift this narrative or this tone in a different direction because it's incumbent upon us to make sure that we go fast because the clock's ticking.
Yeah, I think many are. I don't want to sound like an indictment of my peers. I think we have a lot of strong leadership in this community. It's just one of those things where you've got to kind of keep saying it, right? You kind of have to keep saying it to yourself, to be honest, because it is tempting to get drawn into something that you've been successful in and found sort of a good path forward through policy in the past couple of years. So it's not so much an indictment of any specific leaders in the industry. It's just a general observation that I think we need to shift not only a pattern that's been there for the last 2 years, but a pattern that frankly has been for the history of the industry. Right? We've really kind of spent our entire lives as folks who are quote unquote the good guys, going to DC with our hands out, asking for people to solve our problems because our problems are big, they're important, and they mean a lot to the future of our planet. Similarly, we've also got a pattern of being kind of optimizers, tuners, and tweaking the numbers, financial engineering, whether it be tax equity or, trying to get your cost of capital down, build and flipping to, low cost of capital investors. We have this sense of being kind of a policy-driven industry that only really works in low interest rate, low capex or ever declining capex environments, right? Internally, and we can talk about it more as we go forward here in the conversation, but internally we refer to that as the Goldilocks business model, right? It only works when interest rates and, capex are kind of just right, So it's not something you want to, balance sort of the future of the planet on. And I think that's what we really need to move out of is like, as leaders, we need to understand that what we've done in the past is just not going to be what, kind of drives us forward. And for better or for worse, the IRA has put kind of the fate of the planet in the hands of, a bunch of ex-bankers and utility executives like me, so it's not really, I'm not sure. I hope that we're up to it. That's what I'm saying.
Well, and that's why I tell people all the time. I say it a lot on this podcast. Look around at the executives that are leading our industry. They're all finance guys and women. That is such a key piece of what is happening here. It's not, the technology's proven out. It works. We know how to build these projects. We know what they look like. We could use more engineers, but we know how to integrate and to deploy these assets. But making a pencil is always the hardest part, it seems.
Yeah. That's true. And I think I would go even one further and say it's a specific type of finance executive, right? And again, it's on me. I'm not going to throw rocks at other people, but It's people like me. My whole background is project finance, right? I'm not a growth equity guy. I'm not a tech guy, right? Like what have I been rewarded for before I was a deadbeat executive when I was in a functional role? It was reducing the cost of capital. It was optimizing the financing, right? It was, tuning the tax structure. So, I taught project finance for 10 years. So it's those observations, I think, that it's not even that we're a bunch of finance people, but a very specific type of finance people. Infrastructure, yield-oriented, dividend-oriented, low growth, low cost of capital, interest rate sensitive, bond packagers. That's what we are. And that's not what's going to save the world, because if you haven't noticed, that's not a very scalable or fast-growing business model.
And we're going to get to why you think that all needs to change and what you think we need to change into in just a second. But to round out this policy piece, just a last note here on NextEra. CEO John Ketchum recently tried to tamp down some investor fears over a potential Donald Trump victory and what that would mean for the Inflation Reduction Act, whether we'd see legislation undone, so on and so forth. How do you feel about that issue particularly? Are you concerned? We hear a lot about like Trump proofing businesses right now and how we can survive to make sure that we're not, left holding the bag if there's a change in the White House.
Yeah, I mean, I'll be honest. The thing that I've told my policy and tax and other teams that were otherwise working on IRA guidance and procurement team to do starting at the end of last year was put it down. We've got what we're going to get. And now we got to go optimize the business. And so we literally have a work stream in our goals for this year where all of those groups are working cross-functionally to quote unquote, exactly as you say, quote unquote, Trump-proof the business. So whether that is, getting ahead of commencing construction on certain projects to take advantage of the guidance that's in place now, or, other sort of procurement related plays, legal and permitting plays where we can take advantage of the agencies that are friendly right now but won't be in the future. Those are the things that we're very focused on. I do have to say though that I think there's a lot of partisanship, but I think that there's two elements I'd cite. I think Republicans are still a business friendly party. Right. And they still understand sort of, for lack of a better term, what's often used in infrastructure and project finance as a contract sanctity. Right. And the notion that you can't sort of make the United States into a, banana republic. Right. You can't go back on things that were policy that, some of the largest, energy businesses in the country or the world invested billions of dollars based upon. Right. That really makes the United States seem unstable and impacts the United States as a government and a capital markets participant in a way that is negative. And so I think that that's one piece that no matter how against the policy they are, they will have to respect. It is not lost on most people, I think, that the U.S. government has hardly ever, maybe ever in its history. I'm not a tax policy historian, although I'm not sure. I'm sure that exists, but
I hope not.
I'm
for
sure.
Their hypothetical sake,
it's fascinating. So I mean, John,
bankers are twisted.
Is it really?
You guys are messed up.
But I do think that it's been rare, if ever, that the United States has gone back on a policy that people relied on. Right? They've changed them going forward, but so that's the first piece. The second piece is just the manufacturing story we've got. Right? I'm not only manufacturing, but projects. More than half of the money, I'm seeing statistics like 60% of the money from the IRA that's being deployed so far is going into red states, right? And I'm having conversations with congressional members and governors and others in several of those states, people that are in our supply chain, people that are in states that we're moving into, where they know where it's coming from, right? They don't want to acknowledge it, but they know where it's coming from. When you step back from the whole thing, honestly, I think there's a really interesting sort of set of examples in what just happened with the border policy, right? You have the Republican Party who asked for a certain thing, they got it, and God bless Senator Langford from Oklahoma. I mean, that guy is, someone we should respect and honestly, like, one of the few politicians I think who's still kind of doing it for what he believes in and genuinely trying to move things forward. I mean, he took it on the chin from his own party, but you can see this sort of at the core of it. They're constantly trying to balance policy and politics, right? And in an election year, on the border policy, politics won. But I think, once people are elected in the first or second year of an administration or a government, I think you're much more likely to have people, less political pressure, looking at policies and saying, am I really gonna, screw over the governor of, 4 large Republican states?
Georgia, Tennessee.
Yeah.
Like that's where this money is going.
Exactly. Ohio, Louisiana, Alabama.
Right.
Like, yeah.
Yeah. It's not going to Massachusetts and Connecticut and New York and in California.
Yes.
I mean, that's for a number of different reasons, labor being one of them. But you even see Governor Kemp going to some of these factory unveilings and at times trying his best to say, this isn't me advocating for clean energy over fossil fuels. This is me advocating for jobs and investment, and we're benefiting. Yeah. And so we're going to lean into it.
Jim Justice opened the Form Energy plant in West Virginia, right? Was speaking there and at the ribbon cutting and that. I mean, you're seeing these governors and showing up in places that they otherwise wouldn't, because there are thousands and thousands of jobs here, right? And I'll finish kind of the politics maybe by just saying, like, this is what we have to do as an industry now. We've got a little under a year, and we've got to get out there. We've got to spend the money. We've got to reach deep into our wallets. And I mean it, guys. Everybody who's listening, if you take the number you have in your mind for what you think is reasonable to give to political campaigns, to, voter organizations, all of those, and multiply it by a lot. Because it is unfortunately, we progressives don't like to talk about politics, money in politics. We don't like to think that that's how it gets done, but that is how it gets done. So, this is an arms race, and we've got to really double down there. But I think most of that money and most of that effort and time and, mobilizing people to go door to door and whatnot has to be spent on making the connection between the IRA, the CHIPS Act, the infrastructure bill, and the prosperity and the growth that people are seeing in these communities. I mean, I grew up in Central Ohio, and the economy there is booming. You got the Intel plant, you've got an LG battery facility, you've got First Solar, not in Central Ohio, but expanding in Northeastern Ohio or Northwestern Ohio. It's folks just don't know where it's coming from as clearly as they need to.
Yeah, and they're not going to get that from trade media people like me. I think it's not for a lack of trying that disconnect exists, but it's clear that with the voters and the general public, the IRA and all this clean energy investment is not translating to here's how it's benefiting your life, and here's why it's benefiting your community and your, friends, family.
I mean, that's what we gotta win that kitchen table argument in 20 counties in the United States right now. Take the 20 counties that are going to decide this election, or take the 30, 50 counties that are going to decide the election. Find the 20 where we as an industry have the most impact, either through manufacturing, supply chain, or projects. And then let's get in there and tell that story. Let's tell it to everybody who'll listen. Let's go door to door.
And you're saying your SIA and AP memberships aren't enough. You need to write some checks.
That's exactly what I'm saying. That's exactly what I'm saying. Because
no slight to Abby Hopper. You can send them checks too.
Those associations have to manage a whole bunch of myriad interests, right? And those associations aren't necessarily strictly partisan either, right? So I think they have to watch, where they're putting their money, how they're deploying, their time, and they're also deeply entrenched in finishing some of these more detailed elements of the IRA. So I don't think they're meant to be sort of political action type groups per se, and in kind of this big of an election fight. I think we really do have to have leadership in the industry, leaders, personalities stepping up in the industry, motivating people to get out both, their people, their capital, and their platforms in support of the president and this, the legislators that have gotten us to where we are. And, anything less than full-throated support is frankly cowardly. We're a bunch of sort of like, cocktail party liberals who sit around and want to have interesting conversations about, well, is the president too old? Is there another nominee? The youth of the Democratic Party. Well, you know what? There's a whole lot of people who are smarter than me and smarter than most of the folks having those conversations that have done the calculus. They've done the math. It's their day job. It's not mine. And they've determined for many reasons that this is the best path. And, I'll tell you, the last time we didn't have a presumptive Democratic nominee, it was, right before the South Carolina primary. Why don't you all take a few hours and go back and rerun the cable news for the last 3 months prior to that moment, and we'll talk about whether or not the Democratic Party was in any position to defend itself in those 3 months, right? I'm not looking to go back there. So again, I just think it's time to unify, organize, get the resources out, mobilize, and get behind the folks that have supported us and that support climate progress.
So let's get back into this overarching topic of lasting stability, which I think is, the politics piece is certainly important to that. And I've brought up NextEra a couple of times. The reason for doing that is, NextEra has been the bellwether for this industry. Largest clean energy developer in the world. Here's the example of how it works and why it works, and we need to follow them. And they're our North Star. There have been some tough quarters for NextEra. I speak to people internally all the time about the deliberations and decisions that are happening internally there as a result of the financial struggles and the market conditions and so on and so forth. So to get back to this idea of a better business model and getting out of those factors that you mentioned earlier about the Goldilocks scenario, that we need low rates, we need low capex to survive. How do we shift into being growth vehicles and not being so dependent on those things?
That's the probably, multi-$100 billion question.
Well, you got 33 minutes to do it. So
all right. Well, the good news is I've given a lot of thought to this well in advance. So hopefully we can encapsulate that thought in 33 minutes. But I think we start by just talking about what is, right, and what is out there right now. And it strikes me that you have a whole host of folks who've bought into, in the last wave of financings, we can talk about kind of, where those smaller players are, not just NextEra. And I'll also caveat this by saying I'm not a NextEra expert. I don't know, Lord knows they are and have been a tremendous force for good in this industry. They have built this industry. They are the only example we frankly have of a
and that's why I'm using them. That's the headline.
Yeah.
That's what people can connect with. Oh, maybe things aren't so good. Because if the top dog is struggling, then are we all struggling? So that's just, I'm glad you said that, because it's a starting point.
We owe them a tremendous amount. And, the yield co-structure was very innovative at the time. I think that if to make my comment on what surprised me about NextEra this last fall, I'll start with sort of like the small guys, right? So Recurrent, the company that, I helped build, the last company that I helped build was, we're build and flip developer, right? You've got this kind of mid-market Recurrent, 8-minute Avantis, kind of these medium-sized companies that are building and flipping kind of billions of dollars of assets. And every one of them and a bunch of smaller guys started to, a couple of years ago to do kind of what we did when we started Intersect, which we were maybe 2 or 3 years ahead of them, which is to say we want to move from build and flip to being an IPP, to owning assets, right? And what's interesting is for Intersect internally, that's always kind of just been the price of entry, right? It's sort of just been like, first we're going to go prove we can develop. We did. We sold that portfolio to SoftBank. Then we're going to go develop our own portfolio, which we own, and then we're going to go and innovate, right? And I think what's interesting is that for many, like building an IPP, building one of these smaller build and flip developers into an IPP is visionary. And for me, that's sort of like welcome to the power industry, right? every gas-fired generator, bunch of the big nukes like Exelon, Calpine, these guys have, been at this a long time. That business model is well worn. There's nothing innovative about it. So, I think that's the first thing is we just got to stop congratulating ourselves for finally being able to own assets outside of flipping them to pension funds. The taking that and relating it to sort of the bigger public bellwether situation, I think what shocked me or surprised me, and I think probably surprised others, is that when people ask the very question that you're asking, John, the kind of what is the future of this business? I think they wanted to believe that it was this big public IPP holdco, right? That owned and ran kind of competitive generation nationally. And that looked like NextEra. It looked like Exelon. It looked like, some of these companies. And I think that they looked to NextEra and said, wow, that's the integrated energy company, right? The green super major, if you will. But what happened when you unlocked when interest rates rose, and again, I'm not an expert on what happened. I'm just reading the same papers you are. But it seemed to me that what happened was when interest rates rose, it laid bare kind of the whole build and flip development model's reliance on, what I called the Goldilocks, right? Record low interest rates, ever decreasing CapEx. And what you saw was that actually NextEra was sort of just the build and flip development model on steroids, right? It was sort of just, wow, we have our own captive entity that we flip to, and there's a lot of financial engineering in there that we use to really crunch down the cost of funds at massive scale, and you get this beneficial cycle of earnings from the flipper, right? The development entity, and then a yield-based instrument at really, really low cost of funds, which in a low interest rate environment is attractive because you're able to generate yield that's outside, superior to bonds with probably a similar risk. So I think that realization that actually while it is at scale like nothing else, and certainly I've never built anything like it, and there's a lot of credit due to the folks who built it, it is still fundamentally a build and flip development model. It is not necessarily they're not taking a lot of innovative sort of market risks and hedging them, or finding ways to lay them off, or using different commercial structures to grow the business. It is fundamentally financially engineering and cost of capital based. So that's my observation. That's where I think we're trying to do things a little bit differently. And it's linked to our market strategy as well, right? Our market strategy and our financing strategy are sort of inextricably linked, which we can talk about.
Yeah, what is that strategy? I guess that's the question. Yeah. And now you only have 27 minutes. No, I'm just kidding. But no, that's really helpful context though, because I think that if we're looking at not only who is the bellwether today, but who do we want the bellwether to be, and what do we want that to look like, and how can that serve as an example for the rest of the industry? Because you mentioned that becoming an IPP is not innovative in the sense of it's a new concept. I think in the development world now, everyone and their mother is a vertically integrated IPP that has its own EPC arm that maybe only has 2 guys, but we say we do full EPC services and we own and operate projects. Maybe we do, maybe we don't. That's become, like in the tech world, you have to say you're AI enabled or you're not going to raise money. I don't know. Maybe that was rambling.
No.
I just kind of I went off there.
No, it's exactly but it's spot on. I mean, we're just sort of rolling out the sort of standard playbook again, right? It's okay, well, the gas-fired guys, right? The gas-fired guys went and they built IPPs. They moved from being sort of like PERPA developers who were bootstrapping project finance and then bringing in sort of pension funds or low cost of funds guys. And they did that through most of the late 80s, 90s, and then going into the late 90s, early 2000s, they started saying, oh, hey, there's a public capital market here that's pretty good. Let's go out and start, tapping that. And so they took these sort of IPP business models that frankly were not only IPPs, but a little bit more evolved than even what most of the green guys are talking about, because they had more of a merchant revenue model, which took a little more market exposure and didn't have as many long-term contracts. But yeah, you had the Calpines and the AESs of their day and the El Pasos and, like all of those guys out there in the marketplace with competitive power, vehicles, right? And the public equity markets ate that up. Now, I think that what was being sold there as the premium that unlocked the public markets is the word we need to talk about, and that was growth. And I worked for a guy at Calpine, Pete Cartwright, who was the CEO of Calpine, who is was a legend, and one of the guys who really transformed the power industry to begin with to the kind of competitive generator model, but. When you lay out the growth that they were chasing, Pete had this idea. His business plan was kind of, I think it was like 70 gigawatts, right? And it was this, but no one really knew where the 70 came from, right? And it wasn't like there's this market and it's getting this big and we're going to take this share of this market. I mean, there was some of that, but it was always just, we're going to get really big. And I think when you look at what was driving the gas boom of the late 90s, early 2000s, it was really just, the move away from a lot of utility coal, the deregulation of a lot of states that allowed for more competitive power to come in, and the changing of like the utility business model to kind of get some more competitive power. If you were to kind of sit back with a kind of a McKinsey analysis, that kind of the sort of TAM of that growth, the total addressable market of that growth was big, but not anywhere near as big as what we have in front of us right now. I mean, make no mistake, we're not stopping until we rebuild every single bit of the built infrastructure, not just the power infrastructure, but the like total energy and industrial infrastructure in a lower carbon fashion. It's just massive. And so whereas those guys tried to sort of jumpstart a public market vehicle or business model, I don't know what that is.
What is happening? Were those balloons?
I occasionally it happens. I'm on a Mac and they did this anyway. We'll
No, we're leaving that in.
I think you should
and
leave that in.
For podcast
sure.
listeners, what just happened was Sheldon was in the middle of explaining, how we're going to revolutionize the clean energy industry, and a bunch of balloons rose from the bottom of our screen, and we are not on Zoom. So I will point out that is not a functionality of this recording platform.
I think that our friends at Apple, who are customers of ours, have integrated their video functionality behind all of these tools.
Yeah, they're just saying thanks for the PPA and some merchant.
I can also do that, John.
Oh my god.
So that one I figured out.
That's hilarious.
Anyway.
I didn't think they could infiltrate my own software stuff, but
it's there. It's there. The AI has us.
Oh my gosh.
But where I was going was just to say that gas-fired boom tried to set up these vehicles around the notion that there was growth. I think it petered out and fizzled out because there was not enough growth. And so when there was not enough growth to kind of feed all the mouths of the public IPPs that had set up there, what happened was two things. One, they over financially engineered and levered up because the capital markets sort of let them, right? So they picked the wrong capital structure to try and feed that growth. And then the second piece is they didn't quite manage or weren't maybe quite as honest or aware of the underlying volatility of their, earnings, EBITDA, all that. And the public markets, when you don't have growth, but you are now, you're not as growthy as you said you were, but you're much more volatile, didn't work out, right? I think that there's an opportunity here to build a next generation version of that, but the similarity is the growth. Make no mistake, we've got to start being paid for and rewarded for and valued on the growth that the platform can maintain and provide to the equity owners, right? And I don't think anybody right now is setting themselves up for that or tapping capital markets in a way that rewards them for that. They're just engineering cost of funds.
And before we get into that growth vehicle a little bit more, just to backtrack slightly, can you explain for those not without an expertise in financial engineering and project finance, why the build and flip model works in a low rate environment and isn't working today?
Yeah. I mean, it's pretty simple business. You can think of it as like bond packaging, right? You go and get a very long-term contract, the longest you can get, 15, 20 years. You get that from a utility. The utility has a balance sheet that is, investment grade rated. So effectively the only risk is, and that contract is sort of take or pay, right? I produce an electron, they buy it no matter what. There's no other risk in it. And then or very little other risk in it. Then I turn around and basically the only risk that the owner of that plant then is taking is whether or not the plant works, right? And so it's a marginal risk layered on top of the credit of the utility. And so it's a nice high price contract. Maybe I sign it in 2010, then I wait till 2000. I have until 2013 to deliver it. I wait until 2012, year 2 to contract the CapEx. The CapEx has now fallen. So I'm getting a big uplift because it's much cheaper to build it than I thought it would be when I signed the contract. That's a big part of the build and flip model. And then eventually I build it and I don't hold it on my balance sheet because I'm a small developer. I flip it to, what was there for many years, a couple of years ago, the very, very yield hungry, especially green yield hungry, pension funds, insurance companies, those guys, and they buy them for very low, levered equity returns, right? And I make a huge amount of money selling, at a cheap cost of funds. I clip, what's called kind of a development fee, or the present value of that payment to me is very high. That's a great business. It's, for lack of a better term, a cash and carry business, right? You get in, you get out, you turn a power plant into a widget, and it's a widget where you can lock the price you're selling it at before you lock the cost. And the cost is, something everybody thinks is just going to go down forever. And you've got very, very hungry buyers because of the state of interest rates. That's the build and flip model. That's why it worked. And in a world where CapEx was actually going down because China, and not necessarily because, Moore's law of solar, although I'm sure there's a little bit of that, but I wrote a blog about that. You can look at that one on the website.
We'll give you a link.
Yeah, but yeah. So in a world where CapEx actually did reverse and interest rates went up, you stall out.
So then going back to the growth vehicle, how do we develop into a growth-minded industry? And why do you want to, or how are you positioning Intersect to realize that opportunity, whereas that, might be an anomaly from others?
Yeah, definitely. I mean, so Intersect is sort of built from the ground up to be this, right? We are a company that is sort of founded on two big questions. One is, what do we do when, the renewables are so cheap and so abundant in certain times, at certain places, that you can't put them all on the grid, right? And that's really led us down this path of, what we call the nexus of deep decarbonization. We've talked about it, written about it. It's also on the blog in spades. You can read endlessly about it. There's other press out there on it. So, but what we mean by that is this, when you have this abundant source of low cost, clean electricity, that is also relatively high capacity factor, right? There are places in the country like the Panhandle of Texas where wind and solar together can reach capacity factors that are, 65, 70%, right? Now you start to have really usable energy for industrial applications, right? And so we identified a handful of about 6 new industries that are very nascent now that will probably be multi-$100 billion industries in a world where we are actually successful in decarbonizing. And those are everything from green fuels, green hydrogen, direct air capture, AI data centers, and data centers in general will need to move, electric vehicle charging at scale, thermal industrial loads. So there's a lot of, carbon being emitted just boiling water. So as people think about just building simple factories with very high thermal loads, whether it's cement or other products like that, they will come to generation. So all of these new industries and a lot of existing energy intensive industries will come to generation. They will come to not just clean generation, but the high capacity factor generation, clean generation at the low cost. So that is sort of like one of the big fundamental founding principles of Intersect. The other one was we don't sign a lot of long-term PPAs. So we're built from the ground up with a trading group and a risk management team. We sign shorter tenor contracts. We take more market commodity risk. I've again spoken ad nauseum about that, but the reason we do it is because we believe that the PPAs, even at today's rates, are priced too low and the margins are better if you can manage the risk of of having more variability in your revenue. You make more money in the long term. Now your revenue is more variable for sure, so it's a higher sort of volatility asset, but the overall risk adjusted return on a shorter term contracted asset is better. And so most of our assets have a lot more market participation, a lot more market exposure. So when you put those two things together, that's the revenue model of Intersect. And this growth we're going to talk about starts with the revenue model.
Yeah, well, I'm interested. You've had no trouble raising money, but how does the investor class view what you're trying to do with more of that, merchant exposure?
Yeah, I mean, most of them, I think, like it a lot. I think it's really a question of shopping in the right pool of capital, right? That revenue model I was mentioning enables the growth, right? Because we're not sitting around waiting for the next PPA to kind of drop out of a PPA RFP process, right? We are able to do things like add batteries, add assets very quickly, right? So because we're not waiting for a big tolling offtake agreement, we're putting in a gigawatt hour of batteries in Texas, and we're going to probably develop them soup to nuts and install them and build them in less than a year.
And instead of fighting with other developers to race to the bottom and,
Yep, in contracting and all of that, right? So the actual way that we go out and contract and structure our revenue and our offtake speeds the development, speeds the progress of the company, speeds the deployment rate of the company. And so it's about, there are growth equity investors out there. They just haven't come anywhere near renewables because nobody built a business that they could invest in, right? And that's what we're doing now. And I think that's where the new public market story comes from as well, right? Because public markets tend to like the growth equity aspect, as well. I mean, don't get me wrong, there are dividend stories and yield stories in the public markets as well. But I think we need to provide an option that is a growth story to the public markets. So I think, when you kind of complete the picture of Intersect Power, when we say we're building kind of this like, next generation platform, we refer to it using a term that I think a lot of people have used, but we refer to it using kind of the term green super major. There's one element that I think goes, even beyond the kind of basic change to the revenue model. And that is when we talk about these new loads coming to gen, right? Green fuels, data centers, all of that. Intersect's business model is not just to serve them. It's to try to actually vertically integrate into some of them, right? And so when we think about the green supermajor analogy, there are two things that we think define a supermajor in the oil and gas industry, right? That we like. There's a lot of things that define it, but two analogous components. One, they're long the market, they're long the commodity, right? They own upstream oil and gas. And two, they're vertically integrated in many ways. So not always. They buy and sell assets. Some of them will buy and sell a business, but a lot of them have petrochemical businesses, downstream businesses. They have distribution businesses. They have all of those businesses. When you put those two things together, that's the magic, because they have a long position and a short position. And so they are less volatile, right? They're less exposed to the market because they're kind of internally hedged. And what that creates is they don't have as much upside when oil prices go wild, for instance, because their downstream business suffers, but they've got a hedge when oil prices go low. And in the intervening, what they have is a ton of optionality, right? They can sometimes move oil or move the upstream component into a different application. They can other times, buy more oil if it's really cheap from some other provider, right? There's an enormous amount of optionality in that system that creates value. So it's that combination of vertical integration and being kind of open to the commodity position that I think creates a very, very dynamic business model that allows the supermajor oil companies to be public, but have an enormous amount of market risk, commodity risk, right? That's what we're looking to build. We want to vertically integrate into data centers. We want to vertically integrate into hydrogen and e-fuels. We want to vertically integrate into all of these next gen loads that will move to generation. And in so doing, we want to create what we're referring to as like a constellation of load and gen. We don't want to be a generating company. We want to be a clean infrastructure company, a clean asset, company, loads and generation. That's the next generation supermajor. And, it has a totally different revenue model. It has a totally different ownership model. It has a totally different financing model, which we haven't even talked about. But that's what's coming. It doesn't rely on a low cost of funds. In fact, it embraces a high cost of funds because it can pay for it because investors value the growth.
So how do you get into that then? Are you doing that through M&A? Are you doing that through joint ventures? Like how would you structure that? Because I think even a well-established developer IPP may be hearing you say, green hydrogen, green fuels and data center load and all of these things and being like, what are you getting yourself into? Just in terms of how expansive that is.
Well, the key is if you're well established, you're actually worse positioned to actually do this, right? Why? Because who's your investor? Your investor is a yield-oriented infrastructure fund, right? Like that, they don't want you to do this. That's the last thing they want. What they bought into the vision. The vision was go build me an IPP, make it bigger, like get more contracts, help me deploy the next $1 billion of infrastructure capital, which is great. We need that as well. But it's very hard then to turn around with an existing investor base and say, actually, I want to go do more market risk at, higher returns, but higher risk, better risk adjusted returns, but more volatility. And in addition to that, I want to vertically integrate in these other businesses as a means of hedging that exposure and creating an enormous amount of optionality that then is really the underlying value of the business of the franchise, right? Trying to explain that to a bunch of established investors is not something I'm going to try and do. I mean, we don't, that's, I don't think those folks want that. So you're actually, a lot of the most successful players to date are actually have their hands tied in terms of getting into some of these businesses. So when you look at what we're doing, we're actually, the good news is that many of these other loads, it sounds like I'm just listing off a random set of things. But if you go back and read my blog on the kind of nexus of deep decarbonization, the whole realization is actually that very, very large scale, high capacity factor, low cost clean energy is in fact the unlock of all of them. It's what they have in common. It is their single largest cost driver. And so, when you think about how close we are to doing a big data center, we're actually not that far away because we're already developing a big hydrogen site, right? And if we have a customer for hydrogen, we can use those renewables, which are the bulk of the real like CapEx and, like land development and all of that to build an electrolyzer facility, or we can use it to build a data center, or we can do both if the site is big enough, right? And so that's what we're really focused on. And we are actually doing the development. We're looking to develop our own data centers. We're developing our own hydrogen facilities right now. So we are vertically integrating already into the first couple of these things that we're focused on.
The way you describe this in each of those different opportunities sounds like behind the meter utility scale, like DER.
Yeah, absolutely.
And
it is.
That's how you see this evolving, and that we still need the folks developing utility scale projects out in the middle of nowhere, but we need to meet Gen where it is.
Yeah, I mean that's I'm gonna tell you one more. There's another blog that's written that I wrote, actually came out at the end of last year, but it's titled something like the grid is broken.
I read that one.
The grid is broken.
I call it I've told you before. I call it the manifesto.
Yeah, and yes, exactly. It is. It's actually just one chapter of a much larger manifesto that
all of this
one day
pieces together. If you don't follow Sheldon already on LinkedIn, it really is like I appreciate the stuff that you put out, because unlike the other communiques that we get from the corporate world where it's just layered in PR and marketing, and here's no offense to your PR team who is listening into this interview, it's just it's layered with SEO and things that'll appeal to a high level, maybe investor class. You really get in the weeds and you don't pull punches, and I appreciate that.
I write my stuff myself, and I don't know what SEO is. So
search engine optimization.
Okay. All right.
See, you need a vertically integrated digital media team as well, and I can help you. I can help you on this mission.
I do need a digital media team. I think though that where we're going hopefully is a cohesive vision. Like if you look across all of the things I've said and written, it really is about this loads coming to Gen. the need for, that enables a different revenue model. That revenue model requires a different financing model, of which we've actually done in our current operating assets and are, continuing to do in the new assets we're building. And, oh, by the way, that all plays very nicely with something I said very early on, which was, Intersect, we were talking about it in the political realm, but Intersect is a company that is much more focused on dealing with what is than focusing on what needs to be to enable our business model, right? And that's really the crux of this grid is broken thesis, which is just no one is coming to fix the grid. Even if we passed a transmission bill or a permitting bill that had a transmission element to it, you still wouldn't build enough transmission to come anywhere near enabling even today's loads, let alone the load growth that we're beginning to see in AI and, EVs and all of that. So what will absolutely happen is that you will see these sort of mega behind the meter or, mega microgrid, industrial scale microgrid kind of, regional assemblages of load. And those will almost certainly happen in the places where you've got the highest capacity factor, lowest cost clean energy. And so it's like an oil and gas land grab. That's it. There's great acreage out there to go frack for low cost, high capacity factor clean energy. And we're tying it up by the hundreds of thousands of acres.
Look what Microsoft is doing. Why are they investing so much money in nuclear? Why does Bill Gates care so much about nuclear? It's because they can't get the power for these data centers. Yeah. They simply can't get it. And a much smaller example, but like Costco doing an islanded solar and battery system to power their electric fleet because they couldn't get it from the utility. Sam Altman, OpenAI, telling world leaders that unless we have a breakthrough on fusion, we're never going to reach our potential on generative AI and so on. So it all goes back to that point that, like, simply put, they can't get the power.
And the grid is not going to supply any of this. You are, I mean, if we have a problem with, an industry of competitive power, a competitive green power industry staffed by ex-bankers and ex-utility executives, people like me, needing to save the world. Just imagine now, not ex-utility executives, but the actual utilities themselves, not picking on the executives, but their hands completely tied by the regulatory regime, the politics, all of that. Now they're being asked to step up and facilitate and enable not only decarbonization, but one of the greatest sort of technological revolutions in maybe in the history of humanity in AI. And that's just, ask yourself how plausible you think that is, right? Do you think it's more likely that some crazy guy on a podcast who's talking about, some revolutionary, change to how we, power large green industrial loads is going to do it, versus, a large regulated utility? I don't know. In the last, few decades, I'd bet on the crazy guy. Like, certainly that's been what's been kind of borne out in other tech sectors and growth sectors. So, and I'm not crazy. I hope that
for a while there, I thought you were talking about me.
Listening, I hope that our investors listening know that if you look at our track record, I think that's the other thing that sort of defines us is that, we have a vision that I think is differentiated, that is new, that is exciting, that is predicated on what is, not what is supposed to be. And, because there are a lot of people out there with a vision, we also have built, $4 billion of assets in the last 2 years, financed them in fundamentally different ways than most of the people in the industry, and are building, a gigawatt hour batteries in 9 months, right? So we are top notch at execution, and we have the vision of what I believe is coming.
I want to round out with this, and you've talked about that financing piece and going about this in a different way. So I'd like you to explain that a little bit more. But you keep talking about this growth equity asset class, and it makes me want to ask about public markets and how you view that and whether that's a track for Intersect in the future. But maybe start with the financing component and we work our way up.
Yeah. I mean, I think when we talk about our financing, when you have a different revenue model in power, again, I taught project finance for 10 plus years at Berkeley. And the one of the fundamental things you learn in project finance is that your revenue model enables or sort of, is inextricably tied to how you finance, right? If you have more market exposure, you have less debt capacity. Usually, if you have more market exposure, you have higher debt costs usually. And so, what we realized was that people were basically, let's say I could go sign a PPA for 15 years, at $25. These numbers are a little dated, but the margins, while PPA prices have come up, so has CapEx. So the margins have stayed pretty consistent, right? So let's just use the old numbers. $25, 15-year PPA. Or at right around the same time, I could probably go out and sign contracts where maybe I signed like a 7-year deal for 50% of the output, or, some combination of shorter tenor contracts and not all of the volume that locked in a certain percentage of my revenue. Maybe instead of having kind of on a discounted basis, maybe I would lock in about half of what I would lock in on a 15-year PPA, right? I would have more market exposure. But the average revenue that I got from that would be closer to like $45 a megawatt hour. So I'm essentially cutting my revenue almost in half because I think I can get more debt capacity and cheaper financing. Now, as we proved it out, and we've built 2.25 gigawatts of projects this way, the accepting slightly more expensive money and, taking more market risk is a superior risk-adjusted return. If you put those elements into your financing model, you find out pretty quickly that you get much higher returns. And in fact, if you then sensitize for downsides on the market pricing that you're taking, you still aren't taking that much more risk. In fact, the person who's got the PPA from year 16 to 35 is still taking an enormous amount of market risk. They're just sort of squinting at it and pretending it's not there, right? Because they're fully contracted. And so the actual sensitivity of the returns of those two different types of asset classes to changes in market price, they both move quite a lot. And in fact, you're almost always better off with the less contracted situation. So that's what we've really kind of, I think, mastered on the financing side, and that works. I think that's sort of the debt financing. And then on the equity, as you said, like, I think what we are sort of teeing up for, I would like to make a run at trying to explain all of what I just explained to you to the public markets. And it's not a simple story, and the public markets don't like complicated stories. So I'm not sure that I can do it, but I do feel like there's a couple of reasons for that. One is that I think we need a new bellwether. I think we need a story that is infrastructure is growth again, right? Particularly green infrastructure is growth again, that the opportunity there is just as big as AI in terms of the growth rates that can be achieved. And all it takes is a new business model, a new revenue model, a new financing model to unlock that. And we have that. So I think we need to be able to tell that story, not just in the capital markets, but I think we need a successful version of that story in the capital markets because society needs that story, right? Because without it, like, look around. I'm not sure. We can all look at, academic models about decarbonizing the grid by 2035, but, it's just not happening fast enough. And so we need a more scalable, higher velocity decarbonization business model. And that's what I think I can sell, to the public markets. But who knows? There are a lot of people who've taken that bet and not made it. Either way, though, there are plenty of sophisticated private market, participants who I think absolutely appreciate the idea. And I think there are lots of successful, ways to keep growing our business. But to your point, I think there are reasons why it would be, beneficial to our investors and also to, the broader decarbonization movement to have a different and better green bellwether in the market.
I don't think I've heard you talk about that before, so I don't know if this is the beginning of your roadshow or not. But I do think it's incredibly interesting. Are you laying the groundwork for that and doing the due diligence internally to position Intersect for that kind of an opportunity? Should you guys decide to go in that direction?
I mean, this is a capital hungry business, right? So we're always positioning and trying to figure out what different capital markets want, what they value, what they're willing to pay for. We probably still have a fair bit of private, market growth that we can achieve. We're growing so rapidly, and we are so, capital hungry right now, that's probably best done in a private capital market environment. But over the next 2 or 3 years, in this next kind of wave of growth, will more than double the size of the company, almost triple it in the next 3+ years. And that I think, we will still be growing very fast, but off a much bigger base at that point. And, that'll be the point at which we got to start answering questions about whether or not there is, what kind of long-term capitalization strategies exist for the business. But I do have to say, I spent a lot of time talking to, kind of the buy-side analysts and equity markets participants. I really enjoy that. I think, again, I really believe that there's a narrative and a story and a business model that needs to be redefined, or I won't even call it redefined, just defined for this industry. And I think it probably does take 3 years to get people on board with what that is, right? It's not a simple road show. It starts with actually just explaining to most of these people how this basic business works. So, there's a lot of work to be done, a lot of wood to be chopped, no matter where we're going.
Well, maybe you'll map out that course in an upcoming blog post in the next edition of the manifesto. Sheldon Kimber, it's always great to talk to you. I really enjoyed this, and thanks for coming on the podcast.
John, thanks so much for having me, and I look forward to hearing about how we crop out the various visual effects.
Those aren't going anywhere. We'll see you soon.
Thanks again to Sheldon Kimber for joining the podcast. Factor This is a production of Renewable Energy World and Clarion Energy. Join us every Monday as we break down solar's biggest stories with industry leaders who actually move the needle. And please leave us a rating and review wherever you get your podcasts. Thanks for listening, and we'll see you next time on Factor This from Renewable Energy World.